Okay, let's get started. Unit 14 is the real estate related computations and closing transactions. The mathematics. This is one of the three heavy mathematic units we're going to be going through. Let's just get started. Just go through some basic math first of all. You do need to know how to work out parts of a fraction, change in fractions to decimals, and change in decimals to fractions, decimals to percentages, and percentages to decimals, and decimal place values. Let's remember a fraction, 1/4. On the top, you've got the numerator. At the bottom, you've got the denominator. Basically, the 4 are saying how many total parts do we have in the whole unit, and how many parts do I personally have? 1. So in that particular case, it's like a pie is divided into 4, and I've got 1/4, so we can call it 1/4 like that. But of course we can call it other things as well. What would that be as a decimal? Divide 4 into 1 gives us 0.25. So there's another way. We've changed the fraction into the decimal by dividing the bottom bit into the top bit. How about if we got more than a whole unit, more than one? Now supposing I am in possession of 5/4. How would that be as a decimal? Once again, you divide 4 into 5 and I have got 1.25. That's the same as 1 1/4, of course. How about changing decimals into percentages? Well, in this particular case, I've got a 0.25 or 25%. To change it into percentage, 0.25, I literally move the decimal place 2 points to the right, or 2 places to the right. And that's the same as multiplying by 100, and that gives me 25%. Changing decimals into percentages. Once again, just move the decimal point 2 places to the right, which is the same as multiplying by 100. And in this particular case, I've got 1.25. That becomes 125%. How about changing a percentage into decimals? Well, literally, all we have to do to get the 34% into a decimal, in this particular case, we've got to divide by 100. So we would move the percentage sign 2 places to the left and then change it to a decimal point. So in that example on the board, 34% becomes 0.34 or 0.34 if we want to make sure. And 7.5% equals 7.5%, which equals 0.75. You do need to get a handle on this. Finally, just working with decimals, 1 equals 1/1 or 100%, 1. 0.1 is the same as 10% or a tenth. 0.01 is the same as 1/100th or 1%. And 0.001, which we use a lot in our property taxes as mils, it is 1,000th, or sometimes we call it just 0.01%. When we talk about sales commissions, this is what we're in it for, to get that commission. The commission, you've realized by now, is shared usually 4 ways. It goes from the listing broker and it is shared with the selling broker, and then the listing broker and the selling broker share it with their sales associate. So it goes 4 ways. We will nominate who gets what in the listing contract. A paragraph in the listing contract nominates how much the seller will pay the broker. And if we want to know how much our broker is getting paid when I work with a buyer on a property from another agency, then I look on the MLS and it will show you the different percentages depending on what agency we're representing the buyer. This is called the cooperation or cooperating broker payment. the seller has to agree how much the cooperating broker is going to get paid. So we do also have that on the listing contract. Here's an example. 62,000, 6.5% commission. The associate lists and sells. The associate split with the broker is 55%. So how much does that associate get? 62,000 at 6.5 gives 4,030. 55% of it will go to the sales associate and 45% remaining will go to the broker. Therefore, the sales associate will get $2,216.50 and the broker will get the remainder. There's another one there. Not going to go through that. This is just a quick refresh. And there's another one which we did in class, or will do in class if you're looking at this in advance. We can sometimes come across a graduated commission where not all the selling price is subject to the same commission. Usually in commercial buildings, for instance, this one sold for $325, and we're looking to see that the first 200 of commission is at 5%, the next 100,000 is at 6.5%, and the last 25,000 is at 8%. This encourages the sales agent, the lister, to actually get more for the building, and every dollar he gets more, then his commission increases. So we will pay out on the first 200, 10,000, on the second 1,000, 100,000 rather, 6,500, and on the remainder we'll get 2,000 there. You can pause this and look at this if you would need to understand it, but we have to move on. Total commission 18,500. We've got this triangle, call it what you will, but this is all to do with if I have a percentage and I have a remainder and I have the original amount, as long as I have two of those I can always work out the third. I'm using a box of eggs which is half full with 6 eggs. So for instance, if I wanted to know what the percentage of fullness, shall we say, or what percentage the box is full, I know what my part is, it's 6. I know what the total it could hold is 12, divide those out, and then I get 0.5 or 50%. And it's the same with the others. If I know I've got 6 eggs and I know the rate is 50%, can I figure out what the total box full would be? And so on. We've got some examples. I'm not going to go through those, but they're in the book. Very easily done. And here is another commission split question, which I'm not going to go through. And I'm not going to go through these. We've probably been through these, or you can go through those. When it comes to I bought something for a cost price and I made some money on it, what is the percentage I lost or gained, profit or loss? We need to work out how to do that. The very simplest way to remember that is the amount that I actually made extra on the sale, and I divide it by the total cost of it will give me the profit. For example, what I made over what I paid. Let's have a look. I sold a lot, I got 8,000, sold for 10,000, therefore I made 2,000 profit. What was my profit percentage? So what did I make? 2,000. And what did I pay for it? 8,000, therefore I made a 25% profit. If I made a loss on it, I still regard it as what I made, but it's a negative figure. Lot cost 10,000, I sold for 8, therefore I incurred a $2,000 dollar loss on the lot. I still put the 2,000 on the top, but in this case I just put a negative in front of it. I still put what I paid, which was 10,000 in this case. Therefore I made a 20% loss. Don't get too tied up with the wordage. How about this? I know that I sold a lot for 6,000. I don't know what it cost me, but I know I made a 25% profit. A little bit different. I had more dollars. In fact, I had 25% more dollars when I sold it than I paid for it. If a lot sold for 6,000 with a 25% profit, then that 6,000 represents the lot cost, which is 100% plus the 25, 125%. To get back to the original figure, I would therefore divide the 6,000 by the 125%, which will give me 4,800. As with all math problems, once you go one way and find the answer, you can always go the other way to see if it checks out. In other words, I would get 4,800 and add 25% to it to see that I came up to 6,000. And there's the same thing, but doing it with a loss. A loss, I paid so many dollars for it and I lost 20%. The amount that I sold it for was 10,000. Therefore, that 10,000 didn't represent the full 100% price of the lot. It only represented 80%. Once again, divide by whatever the lot sold for, 80% of the selling price, the cost price, and therefore it'll be 12,500. You need to look over those a few more times if you have a problem with it. All right, there's some other questions there I'm not going to go through. The primary steps to closing, these vary. They're not set in stone, but usually we start off with the earnest money deposit. Then the buyer, if they're using a bank, will go for a loan application. We will be trying to clear the contingencies on the contract, such as inspections and other due diligence activities. The bank will probably want an appraiser, or if you're paying cash, maybe the buyer will want an appraiser to make sure the value is there. We wait for the bank to give us loan approval. In the meantime, we get all of this lot off to the title insurance company or the attorney to start preparing the paperwork. The buyer will probably want inspections and request the seller to do any repairs. And there will also probably be a survey requested. Before closing, the lender will want to see a full year's hazard insurance paid up. Just before closing, the buyer and the buyer's agent will do a walkthrough inspection to make sure the repairs have been done and the home has been left in good condition as seen when the offer was made. We'll look at the closing documents to make sure we understand and agree with everything. And the buyer will be given the amount by the title company that they need to bring to closing. And then at closing, the earnest money will be transferred to the closing agent so they can put it into the pot. And the buyer's mortgage loan or cash transferred to the closing agent. And then the title company fills out closing disclosure and calculates all the amount to be collected and disbursed. But we will have to get some charges and prorations added onto the closing disclosure before all that lot happens. The contract should specify a date and a time for prorating the items so we know exactly in advance what day the closing is meant to happen, because we've got to work some things out in advance. Sometimes a party will have to be given some money from the other side, and therefore that would be, for instance, credit the buyer. Sometimes the party have to pay out to the other side. Okay, so it will be debit the buyer or seller, whatever the case. When it comes to proration, in other words, actually dividing between the buyer and the seller the number of days that is owed, we have two methods. The 360-day method, which the government and banks use tentatively. That means that there's 360 days in a year and each month has 30 days. I've never come across that. It's highly unlikely that you'll be asked a question on it. And then we have the regular one, the 365-day method, which is the actual days in the year, maybe 366 if you're dealing with a leap year. And that will be mentioned in the question of what method you should be using. Something we have to remember, especially on taxes, that taxes are billed and payable between the 1st of November and the 31st of March for the current and previous year. And that means, so when I get my tax bill in November, I'm paying for the taxes that I've used up that year plus to December, and I've got until the 31st of March to pay it. And very often, most often than not, the taxes have not been paid when we are involved in a purchase or sale of a house. The title company will give us a closing disclosure. I'm not going to go through this too quickly in class. I'll go through it rather slowly in class, but I'm going to go through it quickly now. But essentially the closing disclosure is in two parts. One is the costs to both the buyer and the seller, which is on page 2, and the other is the total of all the prorations and credits and debits and the amounts which is due from or to either the buyer or the seller. I'm not going to go through this. We will go through this in class, but just know that that's where all the totals will be, all the calculations will be entered and totaled up. Here's an example. I'm just going to go through one of these, prorate the taxes that have not been paid. Let's quickly go down. You've seen this before, or you will see it, but essentially what we're saying here is that the taxes are 3467 for the year, and the sale closes on July the 23rd. And who pays to whom and how much. So first of all, we've got to decide how much of the taxes per year. Then we have to decide that the seller is living in a house which hasn't had the taxes paid. And when November comes along, the buyer, who is now living in a house, is going to have to pay the full years. So the buyer wants to be credited with the number of days that the seller has lived in the house with so much $9.50 per day. So we have to work out how many days are there between January the 1st and July the 23rd. Thing to remember here is the closing takes place on 23rd of July. Therefore, it will be the buyer living in the house. Therefore, the buyer will not be able to claim taxes from the seller for that particular day because it's the buyer's house. So we have to quickly work out 30 days, have September, April, June and November. But we don't use 23 days in July. We only use 22, which comes to a total of 203 days. Therefore, we have determined that the seller has lived in this house for 203 days at $9.50 a day, and therefore the seller will have to debit out of his pocket and put it into the buyer's pocket, $19.28.50, so that buyer has that money ready for when the tax bill comes. And it will be entered on page 3 as a property tax coming into the buyer's pocket and out of the seller's pocket. Let's do another example. No, I won't. That's pro taxes. Same thing. That's just an extra example we've got there in the book. How about prepaid rent? Now, in this particular case, we have to understand that the buyer in a particular month is buying a house and the tenant, but hasn't received any and will not receive any rent from the tenant because the tenant has given a full month's rent to the seller. So in this particular case, we still have to work out how much the rent is per day, but then we have to figure out how many days will the seller have lived in the house and how many days will the buyer have lived in the house. Well, in this particular case, we can see the seller would have lived in the home 20 days and therefore is entitled to keep 20 days worth of rent. But the buyer will have lived in the house 10 days and therefore will need to extract from the seller 10 days worth of rent because the buyer has actually owned the tenant for those 10 days. And that's how we do that. Once again, it's debit the seller, that's 10 days, and credit the buyer the 10 days. $41.50 a day, 415. And that will go in the same place once again, but on the other side, we can see here that the prepaid rent, $415, has come from the seller's pocket into the buyer's pocket, the same way as the property taxes did. All right. So security deposits and last month's rent. Once again, the seller is holding on to the security deposits and the last month's rent, whereas the buyer will have to be giving those back to the tenant when the lease ends. So therefore, the buyer, in preparation for that, has got to have them those monies in the buyer's pocket. So it's obviously going to be debit the seller, credit the buyer. And remember, when you look at the answers, you can usually eliminate 2 of the answers because they'll have those the other way round. And once again, on the closing disclosure, that would go as a debit the seller, credit the buyer. Unpaid interest on assumed mortgage. This is something that they ask us. They love this one. They're supposing the closings is on May the 8th. The balance on the 1st of May is $93,000 at 4.5%, closing on May the 8th. So in this particular case, the seller is not going to be paying the mortgage at the end of the month. The buyer is. And then it's only fair that the seller pays over 7 days in this particular case, because the closing is on May the 8th, of interest to the buyer. So it's a debit the seller, credit the buyer once again. Now we have to work out how much is the interest per day. Well, at 93,000 times 4.5% divided by 365 gives us about 11.54 per day. Therefore, we work out how many days is the seller going to be living in the house. 7 days. Therefore, once again, we just say 7 days, multiply that out, and we come with $80.78 out of the seller's pocket into the buyer's pocket. And there it is there, unpaid interest, if the buyer is assuming the loan. And this is how we're building up this closing disclosure. And it's not in the book, but I've just done prepaid HOA fees. Now, in this particular case, the HOA fees are $3,650, which is $10 a day. Closing is on April the 15th. That means the HOA fees for the year have been paid, so therefore the buyer is going to be living in all of these days from April the 15th to the end of the year and not have to pay any HOA fees. Well, that's not fair. So in this particular case, the money's going to go the other way. We still have to work out how many days the buyer has lived in the property, but then he has to fork over to the seller that amount of $10 per day. So in this particular case, we work out that the seller lived in the property 104 days. So that means the buyer is going to live in the property 261 days. And therefore, at $10 a day, the buyer is going to have to give the seller $2,610. And in that particular case, that would be up here because it's going the other way. HOA fees $2,160 and HOA fees going from the seller to the buyer. I know the buyer and the seller are opposite on my little diagrams, but that's the way it came out. All right, I'm going to leave it there, and then we're going to go on to transfer taxes in the next video.